give me a countdown or do I just
Yeah,
start?
give it 5.
Do I start?
Yes, whenever you're ready.
Whenever, okay. So are we all clear on the first supplement? It gets a little confusing, but basically, you know, even though your Social Security, if you apply at 62, that is a permanently reduced benefit. The government just feels like, okay, we're just going to take you that far. What you do with it after that is up to you. We're just covering you till you're eligible. Okay. So now we're going to talk about things you need to think about if you're married. And the first thing is survivor election for your annuity. You can do a self-only, which if you're not married, that's what you would want to do. You would, on the application, there's 5 boxes for you to make a survivor annuity election. And box number 3 says payable only during my lifetime. So if you are not married, or if you are not going to leave your spouse anything in case you predecease them, you would initial that box. Box number 1 is for you to initial for a full survivor benefit. And a full survivor benefit for your spouse is 50% of your unreduced annuity. And for that, it would cost you 10% of your annuity. Then you could do a partial, which would give them 25% of your annuity, and it would cost you 5%. You could also, if you're being benevolent, or if you're court-ordered, do a survivor election for a former spouse. And again, you can do a full or less than full. And if you're court-ordered and it's less than full, then you still could, and you've remarried, you could still leave something to a current spouse. If you start making combinations, you can't go over the maximum of 50% of giving somebody 50% of your annuity. And then the last one here is called an insurable interest. That is very rare. There's a lot of extra documentation that you need to submit. You need to show to what extent that person is financially dependent on you for, why that person is financially dependent on you. You have to prove that you are in good health. And there is an extra charge for that in addition to the 10% if you gave them the full amount. And there's an extra percentage charge based on the age difference between you and that person up to a maximum of 40%. So it could cost you up to 50% to give them 50%.
Can you go over that again?
An insurable interest would be someone who's not your spouse. Perhaps a handicapped child that is still living in your home that you're financially responsible for. And you want to be able to give them part of your annuity in case you predecease them. So you could do that, and the charge would be, if you gave them the full survivor annuity, it would cost you, in addition to the regular 10% of your annuity cost, there's an additional percentage cost based on the age difference between you and that person, up to a maximum of 40%. So the 40 plus 10 is 50, so it could end up costing you 50% to give them 50%. Sometimes it's cheaper to do life insurance. But it's just something that is possible. Some people have had significant others that they never married, that they wanted to make allowances for. But once they got the cost involved, it was cheaper for them to go with additional life insurance. Yes, sir.
So, I mean, this doesn't sound too bad compared to some of the people I knew that retired off the CSIS. So you're saying the survivor benefit is 50%, and it only costs someone who has an unreduced annuity 10%.
The regular cost is 10%.
10%.
Yeah, for a regular, for you to leave Are you married?
Yes.
Okay. For you to leave your wife the full survivor annuity, it would cost you 10% of your annuity, and if you predeceased her, she would get 50%. So if your annuity is 100,000, it would cost you 10,000,
Right.
and she would get 50,000 when you pass on. The CSRS calculation is totally different.
Right.
Quick question, if I elect the survivor the 50% and 10% cost, and my wife dies and I'll remarry, we can go back and negate that option, is that correct or not?
Okay, the question is, if you elect a survivor annuity and your spouse predeceases you, what happens? You notify OPM and give them a copy of the death certificate, and they then stop charging you. Okay?
I don't have any plans to fill it in.
No intent.
We're taking that.
That's already a secret.
Insurable interest, yeah, next. Okay, now there's a couple things with that survivor election. If you elect the partial or no survivor annuity for your spouse, then there's an extra paper that needs to be submitted with your retirement application. It's called spousal consent. You cannot throw them under the bus without telling them. Because that form, they need to sign that in front of a notary. So if you do go that route and go to the notary, please make sure that your spouse and the notary date it the same date. You laugh, but we have had them. Like the question that came up, you know, what happens if my spouse predeceases me? You just notify OPM and provide them with a death certificate, and they then stop charging you. On the other side of the coin, if you are not married when you retire, and you get married after you retire, you have up until 2 years after you get married to make an election for your new spouse. However, if you do elect a spousal annuity for your new spouse, it goes back to when you retired as if you were married when you retired. Yeah. No, that says 18 months. I thought it was 2. Oh no, 2 years, yeah.
2 years.
Oh, okay. You can change your. I forgot about that. You can, if you elect no or partial when you retire, and then you change your mind and decide to make it full, you can increase up to 18 months after your date of retirement. You would just deal directly with OPM on that.
That's only if you did no or partial.
Right.
But if it was a 50% deal, then you don't have 18 months to change that.
Right. The full is the 50% is the full. That's the maximum amount you can leave for your spouse. Okay. So now we're going to talk about what's included in creditable service. That would be anytime you're on leave without pay, you do get credit for up to 6 months per calendar year. So you could conceivably be on leave without pay from July 1st of one year to June 30th of the next year and have no reduction in your years of service. It would count, both of those calendar years would count as full years. Anytime you were on workers' comp, it's as if you were at your desk. You never get penalized for being on workers' comp. Part-time service, you would get full credit for part-time service after April 30th of 1986, I believe was the date. But your annuity would be reduced. The system would calculate, it depends on how part-time you were. 20 hours of pay period, 30 hours of pay period, and for how long. And the system would then calculate how much time you worked and compare that to how much time a full-time person worked, and then your annuity would just get reduced by that percent. Intermittent, you would only get credit for the time you actually worked. Seasonal employment, we don't see that much anymore. There are some legacy INS people who had seasonal employment. That also follows, they were put in non-pay status, pay status, and that follows the same rules as leave without pay. They could be in non-pay status for up to 6 months per calendar year with no penalties. Yeah, these. And then we've got deposit and redeposit service. And for FERS, unless, if you had deposit service, and we're going to get into that in more detail in a little bit. Like I said, deposit service would be if you were like on a student appointment, more than likely a temporary appointment, more than likely you were put on what we call a FICA appointment, and only contributions to Social Security were being made. Depending on the timing of that, you could be eligible to make a deposit for that time to count towards your retirement. If it's not eligible for the deposit, or if you don't make the deposit, that time will not count for eligibility or for computation of your annuity. Redeposit is if you had time years ago, like I did, and if you didn't pay it back, those years will not count for eligibility or for computation. So, again, this is the deposit service. Some of it could have been when you were on a WAE appointment as well. As I said, the deposit's required for both eligibility and computation, and the way it's figured is it's 1.3% of your basic pay at the time, plus variable interest rates over the years. Redeposit is if you took a refund, and then all the refunded the calculation on that is the refunded amount plus all the interest. And again, it's got to be repaid for both computation and eligibility. Okay, one, yes.
Sorry. For the redeposit, if the person doesn't remember, because it was so long ago, if they requested that refund or not, how would they find out? Call their human resources?
The question is, if someone can't remember whether they took a refund or not, how would they find out? Yes, they should contact their human resources, and that they can contact OPM, who will check their records and find out. Now, on something that I thought was covered about, and I might be getting ready because I heard you talking to Jeff earlier, on deposit service. It depends on when that deposit service happened as to whether you're eligible to pay it back or not. Anything after January 1st of 1989 is not eligible to be paid. It had to have occurred prior to January 1st of 1989. I don't know why they put that restriction on there, but that's OPM's rules, that the service itself had to have occurred prior to January 1st of 1989 to be eligible for the deposit to be paid. Any more questions? Okay. So this is the process. You could either contact our office if you have deposit service that you want to pay, or redeposit, a refund that you want to pay back. You could contact us, or you could contact the Indianapolis Hiring Center. And you would get this form, 3108. Yes?
And is that date 1/1/89 for both? For redeposit and deposit?
Oh, no, just for deposit service.
Also, not for redeposit?
No. For redeposit, that can be anytime. Yep. Depending on where you get the form from, you would fill out the front part, send it to us or IHC, We would certify it. It would go to OPM. These deposits and redeposits are strictly between you and OPM. Once you submit your form to OPM, they calculate how much you actually owe and send you a statement. And then it's up to you as to whether you want to pay it back or not. You can make payments, pay it off all at once if you want, but it's strictly between you and OPM. Cannot be done through payroll deduction. I believe you could probably set up an allotment. Now, military service deposit is a little different. That is between you and the agency. Of the military people in here, is there anybody who has not made their... Okay. If you want or need those years to count for your retirement, you need to make that deposit. And it's required for both eligibility and computation. So what it amounts to is 3% of your basic pay, and then the interest starts 3 years after you started your federal career. So it's kind of an interest-free period in there. It's a several-step process. The first thing you do is contact the finance center for the service that you were in to get your estimated earnings. Then you send that, once you get that information back from the finance center, you send that in your DD-214 and a form 3108, which is the application to make payment, to payroll. These payments are between you and payroll, and they can be done by payroll deduction. Payroll will figure out how much you owe and apprise you of your choices. Okay. Cost of living adjustments. First off, cost of living adjustments for regular FERS employees do not start until the year after the employee has turned 62. And this is how, when the powers that be determine that they're going to give retirees cost of living adjustments, how they, it's based on the increase in the consumer price index. And this is how they calculate it. LEOs and CBPOs that retire at an earlier age will get their cost of living, CBPOs who retire with the 20 years of CBPO covered service will get it as soon as they retire, as well as LEOs. But CBPOs who are doing it mid-career and have to retire under the regular retirement qualifications will not get it until they're 62.
So you're saying, excuse me, you're saying that regular FERS people do not receive a COLA until they're 62?
So the year after you turn 62. Yeah. Because they're all COLAs are effective the start of the next calendar year.
Okay.
So, all right, retirement commencement date. Voluntary retirement, all FERS retirements start on the first day of the month. And when we say it starts, that's the day you become a retiree. So that's why you hear us encouraging FERS employees to retire on the last day of the month, so that you're a retiree the next day. But you also might want to think about how it falls with the end of a pay period as well. Like for October 31st is the last day of the month, but it's the second Friday of the pay period. So that's a really good date to retire, even though it's not the end of a pay period. Got lost there. Some people have opted for the 27th of a month, because the 27th is the end of the pay period. And, okay, so there's only a couple of days before they would be a retiree. But it could amount, depending on when the end of the month and end of a pay period hits, could affect when you start receiving your money by as much as a month. And it would just depend on your special circumstances. You would just need to talk with your retirement specialist when you decide on when you want to retire and work out a good date. Involuntary retirement, which would be like discontinued service. And I know it says mandatory retirement commences on the day following separation, but mandatory retirements are effective the end of the month that you turn 57. Discontinued service retirement would commence on the next day no matter when it would be. It could be in the middle of the month and the person would be a retiree the next day, not the first of the next month. And a disability retirement is the same. Disability retirements are made effective at the end of the pay period after we've received approval from OPM. So that could happen in the middle of the month. So a disability retiree could be a retiree on the 17th, 18th of a month, as opposed to the first of the next month. Okay, your annual leave payment. You're going to get paid for all of your unused annual leave that you have on the books as of the day that you retire. So a lot of people, if you're going to have a lot of use or lose, that's why a lot of people retire at the end of the year. So that they can, that would be the maximum amount. And you're going to get paid, you'll receive that about, it'll be either the next payday or the second payday after you've received your last pay, which is going to equate to about 4 to 6 weeks after you retire. It's going to be subject to taxes. It will not have any of the other reductions that you have. Now, if you're going to get, it's going to get paid at the rate, it's initially going to get paid at your salary when you retire. But later on in the year, about springtime, April, May, they usually do it, if the government got a pay adjustment at the first of the year, like they're talking 1% for us for 2015. So if you retire at the end of this year, you will get an initial payment for your unused annual leave at your current salary. But then in April or May, payroll's going to start looking at it and see if you had stayed on and used your annual leave. They're going to calculate out how far that would have taken you and give you another payment with that pay adjustment on those annual leave, on that annual leave amount.
Can you go over that again?
If you retire at the end of 2014, you're initially going to get paid for your unused annual leave at your current salary. And then in about springtime of next year, payroll will start looking at everybody that retired. And if we got a pay adjustment, which they're talking about 1%, they will send you another payment giving you that extra 1%. They're going to calculate how far your annual leave would have taken you and give you that extra 1% on that number of years, hours.
So would it be more beneficial to stay to the end of January, and then that increase would already been added into your salary?
The only problem with that is if you've got use or lose leave. So you're still going to get the payment, but if you've got use or lose leave, if you stay till the end of January, the question was, what happened? Why don't you just stay till the end of January to get the extra payment? And the problem with that is if you have use or lose leave, then you're going to lose the excess. Okay. So now we're going to talk about the process. Things that you should do ahead of time. Has anyone been into their EOPF? Not many. Not many. You really should. You should go into your EOPF. If you've not been there, there's instructions on there to get a user ID and a password. EOPF stands for Electronic Official Personnel File. And hopefully, your whole career is in there, including beneficiary forms. It's very important that you go into your EOPF, make sure that your whole service history is there, and that your beneficiary forms are up to date. I cannot tell you how many people come into the service with one spouse. They have gone through a couple of them and either pass away or retire and never change their beneficiary forms. So it's very important that you keep those up to date to make sure that you're things happen the way you want them to if something happens to you. You can request retirement counseling. You can call our office. We'll go over it with you over the phone if you want. You can come down and meet with someone. Obtain a retirement application package. On our website is all the forms you need. There's also extra booklets that we have in the office that we can give to you to help you plan and get through the system, the process. We'd like to have your package 90 days in advance. For those of you that are local, it's easier for us to get up with you if we're missing something or if you didn't sign something. But we like the 90 days in case somebody's on the other side of the world or the other side of the country, because we need the originals. OPM will not take faxes, scanned copies. They want the originals. These are the forms basically that we need. Those are both the retirement applications, 2801 for CSRS, 3107 for FERS. If you had any military service, your DD-214. They even like to see the DD-214 for military retirees. If you're under a court order to provide, if you've gotten divorced, some spouses are able to get part of your annuity, as well as in the order be named for a survivor. So we need any court orders, if you're court ordered to provide health benefits for any minor dependent children.
Question.
Yes?
What about a court order, a divorce decree, where the parties agree not to touch each other's retirement accounts? Would you need a copy of that?
No. The question on there is, are you under a court order to provide part of your retirement or a survivor annuity? And if you check no, then it doesn't say anything. If you check yes, after yes it says attach a copy of the order. So if you do not have to give something to someone, you do not need to attach the court order. I made a mistake one time. I didn't pay attention to that little question, and the gentleman included it. Well, when OPM got his application, and they must not have paid attention to that little question either. They just saw the court order, and they sent it to the legal department for extra review. So it took his payment longer by having that paperwork in there that said he didn't have to give her anything. The 2818, that's continuation of life insurance. If you have life insurance, you need to tell us whether you want to take it into retirement or not. We'll get into details on all your choices later on, but if you have life insurance, that form needs to be submitted with your retirement application. Direct deposit EFT information letter. There is a separate form, but that information is now included as part of the application. So we don't need that separate piece of paper. What is beneficial and very helpful is if you attach a voided check. That way there's no misunderstanding on OPM's part as to what bank and what account your annuity is going to.